Welcome to vTalkInsight, Market Drivers Daily for February 4th, 2026. AI remains the dominant market story, but the narrative is shifting fast as growth stays resilient and leadership rotates beneath the surface. Today we unpack what this more volatile, more selective phase means across AI, global growth, and increasingly divergent markets. Across markets, artificial intelligence is still the central structural theme, but it has clearly moved into a more demanding phase. Investors are no longer rewarding AI stories on narrative alone. They're scrutinizing who can turn massive capital spending into revenues, cash flows, and durable advantages. That shift is showing up in sharper dispersion within tech, more volatile reactions to small AI headlines, and a growing focus on balance sheet strength behind the build-out. A good illustration is the planned combination of SpaceX and xAI at around $1.25 trillion, with talk of an eventual mega IPO that could raise up to $50 billion. The strategy ties rockets, satellite internet, and high-burn AI research into a single vertically integrated platform, including ambitions for orbital data centers and as many as 1 million satellites in low Earth orbit. That creates a powerful infrastructure narrative, but it also means public market investors may one day need to underwrite both cash-generating launch and connectivity businesses and an AI arm reportedly burning about $1 billion per month. Within listed markets, leadership has tilted toward AI hardware and away from traditional software. Demand for memory chips tied to AI is outpacing supply, granting manufacturers pricing power, while data center projects, including a recently approved 530 megawatts in Texas, underline how physical infrastructure has become a key value driver. By contrast, software and SaaS names are under pressure, with a major software index down more than a quarter from its high, professional publishing and data providers hit by new AI legal tools, and high-profile downgrades, such as Adobe reflecting doubts about monetizing AI features. Despite that pressure, AI is already delivering tangible productivity gains and new business models. Enterprises report roughly $4.5 billion of cost savings across hundreds of processes, with more than two-thirds recycled into research and development, effectively turning efficiency into further innovation. IBM now derives nearly 45% of its business from software, growing at double-digit rates, while companies like Walmart and PepsiCo are using AI to refine digital operations and pricing, and banks and healthcare providers move from simple infrastructure build-out to deeper integration of AI into data-rich workflows. At the same time, expectations of 5 to 10% job displacement in areas like call centers and document review highlight that disruption risk is real, even if net hiring may rise in higher skilled R&D roles. The more nuanced phase of the AI cycle is also forcing a harder look at valuations, credit, and politics. Pricing in many AI-related stocks has begun to compress as markets reassess exposures where spending is funded heavily with debt, such as Oracle's debt-financed capex plans and broader use of leverage by large tech groups to expand data center capacity. Credit markets are increasingly demanding clear evidence of returns on AI projects and warning that leveraged issuers without that visibility may face wider spreads. Layered on top are rising political and regulatory headwinds, as concerns grow over who benefits from AI, and volatility stays elevated with small AI signals triggering outsized moves in names like Microsoft, Meta, and Alphabet. Pulling this together, AI remains the core growth engine for markets, but it is now a story about execution, balance sheet quality, and policy risk as much as raw innovation, setting the stage for how it feeds into the broader growth backdrop. Against this more selective AI environment, the macro backdrop still points to resilient, even accelerating growth. U.S. economic activity remains above potential, supported by solid consumer spending, sizable tax rebates, and ongoing AI-driven capital expenditures. Growth forecasts for the U.S. have been revised higher, with expectations now clustering around 2.5% through 2025 and 2026, while blended S&P 500 revenue growth projections above 7% underscore strong top-line momentum. AI and broader IT investment are central to that story. Recent estimates suggest AI-related spending may already account for a meaningful share of U.S. GDP growth, even if more conservative views point to something closer to a quarter to two-fifths rather than half or more. Productivity gains appear structurally stronger than earlier in the cycle, with evidence that AI and digital tools are helping companies do more with the same labor base, and that several years into the recovery, efficiency improvements are still emerging rather than fading. Under the surface, a range of sector-specific growth stories are reinforcing that macro picture. In healthcare, the launch of a new oral GLP-1 pill has seen about 170,000 patients start treatment in just 4 weeks, making it one of the most rapid pharmaceutical rollouts in recent memory and supporting enthusiasm for growth names like Eli Lilly and peers. Spillovers are showing up in consumer behavior, with even niche signals such as rising demand for clothing alterations as more clients lose significant weight. In digital infrastructure, data center businesses are emerging as primary value drivers, in some cases eclipsing legacy crypto operations, while institutional interest in digital asset plumbing such as wallets, staking, and tokenized assets is building despite muted headline crypto prices. Corporate case studies highlight how this growth phase is being shaped by both opportunity and discipline. Disney is committing about $60 billion to expand parks, cruises, and attractions worldwide, while also partnering with Epic Games and investing in Abu Dhabi, blending physical and digital experiences around its intellectual property. Palantir is posting around 60% year-on-year revenue growth, with commercial sales expanding at more than 130% and a Rule of 40 score well above 100, yet its valuation at roughly 56 times forward sales shows how high expectations already are. At the same time, much of the AI capex driving this expansion is being funded out of operating cash flows from highly profitable firms, which helps limit systemic credit risk even as leverage edges higher in some pockets. Beyond the U.S. and megacap tech, growth is broadening across assets and regions. Emerging market debt has seen more than $6 billion of inflows year-to-date, attracted by higher carry and supported by the constructive global backdrop, yet allocations remain small relative to benchmarks, suggesting this is addition rather than rotation away from U.S. assets. Mid-cap U.S. equities are drawing attention for combining stronger earnings profiles with lower leverage than many small caps, and non-U.S. markets have recently outperformed on the back of softer dollar. Risks are not absent. AI's true contribution to growth is uncertain. Valuations in some growth segments already embed ambitious productivity assumptions, and political backlash or tighter credit conditions around AI capex could slow the pace. Even so, the prevailing message from data and earnings is that we are still in a run-at-hot environment, which feeds directly into how leadership is rotating and divergence is building across markets. Headline indices may look relatively calm, with major U.S. benchmarks still near record levels, but beneath the surface market divergence is widening. Recent sessions have seen the main indices down even as a majority of S&P 500 constituents trade higher, pointing to rotation away from large-cap tech rather than a broad risk-off move. Non-U.S. equities have outperformed U.S. markets in the near term, helped by a weaker dollar, while sustained gains in U.S. indices are still seen as heavily dependent on renewed leadership from large-cap tech and AI-related sectors that now account for more than half of index weightings. Style and sector dispersion are also increasing, a rotation that began late last year away from pure technology, and growth has extended towards cyclicals such as industrials, energy, and materials, helped by stronger than expected manufacturing data and earnings upgrades. Within financials, regional banks, as captured by indices like KRE, are up several percent year-to-date, while large U.S. money center banks such as J.P. Morgan, Bank of America, and Citi lag despite solid balance sheets and earnings. Some commentators interpret this as a sign that high-momentum winners may now be more vulnerable than more reasonably priced sectors, where trends remain fundamentally supportive. Divergence is especially stark within technology and alternative assets. Hardware and semiconductor names, including Asian and European chipmakers, have been outperforming as AI-related demand for accelerators and memory remains strong, even with supply bottlenecks at foundries like TSMC, capping potential upside. Conversely, software sector earnings are lagging the broader tech complex by roughly 15%, and concerns about AI cannibalization, legal tools, and data analytics disruption have driven a sharp sell-off in SaaS and financial data providers. In the alternative space, gold has recently outperformed Bitcoin as an apparent store of value of choice, helped in part by easier access and tighter crypto regulation in some markets, while blockchain infrastructure adoption, such as stablecoins and on-chain credit, has not yet translated into higher prices for major tokens. Earnings season is amplifying this pattern of divergence. Investors are increasingly discriminating among AI-linked names, with heightened focus on growth, spending, and revenue quality, leading to very different share price reactions within the same sector. There is growing dispersion not just between hardware and software, but also among the so-called mega-cap cohort, as idiosyncratic risks rise for companies like Meta, Microsoft, and Apple. Some software and healthcare names remain favored for clean growth stories, while others, such as Adobe, face steep drawdowns amid doubts over AI monetization, and European chipmakers may feel pressure from weaker results at peers like NXP despite strength elsewhere in the chain. The upside of this divergence is that market participation is broadening. Leadership is rotating away from a very narrow AI mega-cap group toward a wider set of sectors, regions, and mid-cap names, which could, over time, reduce concentration risk and support more sustainable wealth creation. At the same time, investors are adding hedges, including structured equity buffers, against potential pullbacks in the largest AI beneficiaries, and relying less on broad sector trades as dispersion makes stock selection more critical. Looking ahead, key watch points include whether technology regains clear leadership by 2026, as some expect, how the upcoming SpaceX and XAI IPO plans interact with risk appetite, and whether broadening market breadth continues alongside resilient growth. For now, the dominant message is that the era of simple, index-driven AI trades is giving way to a more complex landscape of winners and losers across the market. Across today's themes, one message stands out. AI remains the central growth engine, but markets are demanding clearer cash flows, resilient balance sheets, and credible strategies as volatility and dispersion rise. The macro backdrop is still supportive, with above-trend growth and broadening earnings. Yet leadership is rotating toward new sectors, regions, and styles, and concentration in mega-cap tech is being steadily challenged. Monitoring how AI capex translates into productivity, how credit markets price leverage exposure, and how market breadth evolves will be critical for navigating this next phase. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.